What a day it was to kick off the month of September in financial markets. I'm Ilya Spivak, head of global macro here at tastylive, and this is Macro Money. There was bloodletting all over these markets as the month kicked off. Stocks down sharply, the US dollar up against all of its major counterparts, save the yen, the other standout anti-risk currency, which also rallied up a storm. The Australian dollar, the more stocks and business cycle linked of the major currencies, taking particular loss here, down aggressively against the dollar. Crude oil getting smashed, bonds higher. The market's clearly starting the month with a very defensive tone after what was a very quiet week last week. So what's going on here? Why did we suddenly fall out of bed after this long Labor Day weekend here on Wall Street? And what are we looking at next? That's what we are going to try to figure out here as we look into the week ahead. We're going to take a look at the major bits of event risk likely to shape next steps here. But first and foremost, let's take a look at how last week fared. And what we find is pretty unremarkable. Despite the fact that we had a very closely watched earnings announcement from NVIDIA, a darling of the AI narrative that has been powering stock market enthusiasm now for the better part of a year, we nevertheless get a mere 0.2% rise in the S&P. NASDAQ actually limps lower a little bit, down 0.9%. Crude oil continues to do its own thing, down 1.7% last week on a volatile week of seesawing back and forth. And of course, it's down much more now. But it continued to largely move to the beat of its own drum last week. But the listless nature of what we ended up seeing in stocks seemed to kind of echo with what we then see in rates and in the dollar. Notice last week, gold a little bit lower, the dollar a little bit higher, euro down 1.2%, yen down 1.3% after strong gains for both in the prior week. So the greenback a little bit stronger. Notice yields do nothing. Nothing at the front end. Nothing at the long end after significant declines in the prior week. So you get the sense here that what you're looking for in what is the market's favorite narrative is simply not there. But you are reminded that it is indeed the market's favorite narrative. And of course, what we're talking about is the outlook for Fed interest rate cuts and the idea that perhaps the Fed is already late to cutting rates. Perhaps the Fed has already missed its window to cut in time to avoid recession. We get virtually no news on this story last week. A dearth of U.S. economic data until we get to the PCE report on Friday that ends up being just about in line with expectations, as it is usually want to do, because of course by the time the CPI and the PPI numbers are out, all the ingredients for forecasting the PCE report with good accuracy are essentially there. So we get a quiet week largely because the Fed's story stops for lack of fodder. And so yields stall. The dollar manages to reclaim some lost ground after the prior week's indignities. Stocks struggle to find catalysts to keep going. Gold inches back some, echoing the same dynamics as you see in the greenback. And so it is with this backdrop that we now enter a week where there's a lot more Fed-relevant data to chew on. And we begin interestingly enough, not in the US, but in Canada, where we're going to get a monetary policy announcement. We are currently at a 4.5% rate on the target overnight rate for Canada. The expectation overwhelmingly that we're going to come down by another 25 basis points to 4.25. And if we can see what we have anticipated in Fed or in interest rate futures, rather, Fed funds is, of course, the U.S. version of interest rate futures. In Canada, it's a different benchmark. But what we see in Canadian interest rate futures here is that by the end of the year, the markets see rates at 3.75, off by just a single basis point here. And that means 3 more cuts are on the menu. So to come down from 450 to 375 would be the full amount here, would be a further 75 basis points in cuts. So there appears to be all of the runway here to continue easing. Notice, since the last time that the BOC met in late July, the outlook has become more dovish, echoing the fact that the Bank of Canada seems very clearly minded toward rate cuts and seems to want to move on that. So we now have established what is essentially a new baseline for greater easing. And much of the question vis-a-vis the Fed here will be, what will the Bank of Canada give as its assessment for the U.S. business cycle as part of its own calculus? Notice what it showed in July in its forecast update by way of reference. If we look at why the Bank of Canada is cutting rates, notice their outlook for domestic demand in 2024. It's steady. 1.7% is the expected annualized growth rate, unchanged. There's some shuffling around here. Consumption upgraded a bit, housing downgraded a bit, government spending and business investment basically steady. So as you shuffle these numbers around, you end up basically where you started. A little bit of a downgrade for next year, a little bit of an upgrade for the year after that. No big story here for domestic demand. The big difference is here. And as a result, there is a downgrade of overall growth expectations. What you see here then for overall GDP right here ends up being a downgrade. And it comes from a weaker view on exports. Now, that, of course, is tremendously important because 80% of Canadian exports come to the U.S., give or take. So Canada is intimately attached at the hip to the U.S. business cycle. So if the story from Canada is going to be as dovish as it was, arguing that inflation is all but tamed, at this point, the Bank of Canada sees returning to the 2% inflation target next year. And if the reason that it is because the economy is weak and the reason for the weakness is exports, that is a story about the U.S. as much as it is about Canada, if not more so. And that, of course, enters into the calculus for whether the Fed is going to move with a big rate cut or a more modest one when the FOMC convenes again on September the 18th. It is the same story when we get to this week's key U.S. releases. ISM manufacturing and service sector surveys will give us a more timely estimate of growth dynamics than the lagged GDP sort. And we've already had the manufacturing numbers out. We can see that they were slightly worse than expected, 47.2 versus 47.5 expected. So, of course, this works in the logic of PMIs, where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So what you see here from July into August is that manufacturing continued to shrink in August, and it shrank at a slightly faster speed than consensus forecasts had it. When we look at what's coming from the services sector later in the week, the expectation is we're going to be relatively little changed, a little bit cooler on the growth rate down to 51.1, but nevertheless a positive growth rate and still in positive territory after the June shock here, which was an unexpected contraction in the service sector and the fastest one since all the way back here in late 2022. So what we're looking at then is, again, how much is the Fed going to cut as a framework around this? And if we consider what the manufacturing numbers had, they don't look especially encouraging. New orders down and down to be contracting at the fastest rate since back here, mid 2023, so over a year ago. When we look at the employment side of the story, again, shrinking. And the pace of contraction has somewhat improved over the past 2 months, but nevertheless, we have seen contracting employment here basically every single month since the tail end of the second half of the year here. So looking back, we can see this right here is May. And so over the course of June, July, August, we can see employment has gone from a brief expansion sharply back into contraction mode. And as of July, it was actually shrinking at the fastest pace in years. At the same time that new orders and employment are contracting, the pricing structure is actually going the wrong way. And this is, of course, the biggest sort of concern for Fed policy officials. They've signaled in the most unambiguous way possible that they want to cut this month. But whether they can cut a lot or a little will probably depend on whether they believe the economy is doing badly enough that they need the big cut, and if inflation is moving lower with significant momentum at the same time. This seems to suggest that both sides of the equation are working against policy officials. Employment and new orders suggest that conditions, at least in the manufacturing sector, are becoming cyclically more defensive, even as the pricing structure goes the other way. Essentially, leaving the Fed between a rock and a hard place if this is what carries over into the services sector. And then, of course, rounding out the week, the most important piece of data in this calculus, given how much emphasis the Fed has put on the labor market since early July, the U.S. jobs report, this time expected to give us 160,000 jobs added in August. That would be, of course, a pickup from the measly 114,000 added in July that very clearly stoked such wild market volatility on August 2nd and August 5th. The unemployment rate seen coming in from 4.3 to 4.2%. Now, if we had to distill all of these things down and say all of these things are going to tell us one thing this way or that, and it is that thing which will be defining for markets. This is that thing. The probability that the Fed issues a 50 basis point cut in September is now 37%. The likelihood that they deliver a smaller, standard size 25 basis point cut is 63%. So the market is leaning, clearly, in the direction of a standard size cut, but the likelihood of a 50 basis point one is nearly 40%, which is very high and suggests the markets see a very strong degree of uncertainty around this outcome. Typically, with a mere 2 weeks and change before a Fed meeting, it is much more tilted in a direction and much less of a 50-50 coin toss than what this is. And the market's evolving relationship with this outlook since the beginning of July suggests which way we might be leaning, at least in relative probability terms. Notice what we've been watching here. Since about mid-April or so, the outlook for Fed rate cuts over this year and next has become increasingly dovish. So the markets went from 76 basis points in cumulative cuts this year and next being baked into the market. In the gray is this year, in the yellow is next year, the orange is the sum. To now, by the end of June, before we even get into July's shenanigans, by the end of June, nearly double this at 133 basis points. Why? At this point, the Fed is telling us inflation isn't falling as fast as we want. We're probably not going to do as many cuts as we thought we were going to. You see that in May, as the Fed bemoans the lack of progress on inflation. You see it in June, when they formally revised their official forecasting from 3 to 1 cut this year. How do the markets onboard that information? Well, they say, okay, so if you only wanted to do 1 cut, and the baseline was 76, we'd keep 25 here, we'd move 50 basis points into 2025, and stay about at this level. And you can see this hold up for a bit. But then the markets become convinced, seemingly, that the Fed is wrong, that the Fed is late, and that its reluctance to cut in 2024 means it will have to cut more and faster to catch up next year, essentially creating a kind of exchange rate between rate cuts this year and next year, where for every rate cut lost this year, we add 1.5 or 2 cuts in 2025. And that's how you get this yellow area ballooning out as the gray area stays basically put until we get to the beginning of July, where the Fed says, okay, now we see the urgency. Now we're ready to cut. You first get it in very early July, before that month's Fed policy announcement, which is here. Incidentally, that happens the same day as the Bank of Japan policy meeting that everybody was quick to finger as a culprit for the subsequent sell-off. Don't blame Japan. It starts much earlier. At the beginning of July, the Fed starts the signaling with Fed Chair Powell going to Congress for semi-annual testimony and telling them, we now think that the risks to inflation being too high are about on par with unemployment being too high. And that, of course, starts a process. The Fed reiterates this at the policy announcement. The markets then get some weak data where they essentially panic and say, oh, well, if they're getting ready to cut now, all of our suspicions that they're late have come to pass. Now there's a sense of urgency, and now the data is going in a bad direction to underscore the point. We recover as the data evens out a bit. We get some more encouraging numbers, retail sales, for example, and the next CPI result is not quite so stark. But we end August with essentially a reset where we get back to where we were in the immediate break from these highs right here. And if we notice through this whole period of recovery, the outlook for Fed policy doesn't actually change. It stays pinned to about 2% in cuts over this year and next, suggesting this rebound here is more a reflection of the panicky sell-off before rather than anything actually changing in the underlying mechanism of what's going on. Very tellingly, this top holds, and this rally never even tries to come back to retest it. It just comes back to where the breakout occurred initially. And of course, now we're back on the defensive once again, and still the outlook hasn't changed. Why did the market think this? Why did the market think the Fed is late? Well, we can see that U.S. economic data from about mid-April or so started to aggressively disappoint relative to forecasts, signaling that the Fed should probably be cutting already, but wasn't. We can also see that in recent weeks, data flow has kind of anchored a bit relative to forecasts. It isn't so much turning better, it's just not getting worse. And this sets up an interesting dynamic for this week. If the expectations for these numbers, the NFP number here, the unemployment rate, the ISM number here, if they come out pretty close to forecasts or within reach of forecasts, echoing the anchoring right here, then the case for a 50 basis point rate cut is going to look somewhat flimsier. And if what the markets want now, because again, based on this, they think the Fed is late, and that's their lens, if they don't get the 50 basis point cut, or think a 50 basis point cut is less likely after this week's numbers, well, then the Fed just becomes more late. And then the risk of recession actually grows. In this sense, the markets want the bigger cut. And data in line with forecasts that takes away some of that urgency may actually be negative for stocks and positive for the US dollar, because the markets at this point seem less concerned with the actuality of the US business cycle. They are as ever forward-looking, and more with whether the Fed will put its foot on the gas pedal. And if the data gives them the out not to do that, then a sense of disappointment may well hit Wall Street. And that is macro money for today. As ever, we are here right after overtime this week, somewhat abridged by the Labor Day holiday. So we're here Wednesday through Thursday, I'm going to get this right now, Tuesday through Thursday. Normally, of course, we are here Monday through Thursday, right after overtime wraps up. That's a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what it might mean going forward. I'll be on with Victor Jones, as usual, for the Price of Truth on Wednesday, on with Chris for Futures Power Hour Friday, back with Victor and Tom on Sundays for First Call, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow.